In this video, we're going to be discussing another one of the foundations in accounting, debits and credits. These two little words don't seem like much, but they're, in my opinion, the most important aspect of accounting. Accounting is essentially built off of these two little words. With that being said, let's get into it. One thing I want to bring your attention to is that you're going to see not only in this video, but probably in your textbook as well, is the abbreviation DR and CR. DR is the abbreviation of debit and CR is the abbreviation of credit. I just wanted to point that out just in case you see those terms in this video and wonder where the heck they came from and what they mean. Since debits and credits can affect accounts differently, we cannot simply say that one always increases an account and the other always decreases an account. Everything depends on the account type we're recording the transaction to. If you watch my video on the accounting equation, you know that when I say account type, I'm referring to whether the account is an asset, liability, owner's equity, revenue, or expense account. Rather than defining debit and credit, I simply want you to remember the phrase debits on the left, credits on the right. What I mean by that is, which side of a T account does the debit go on and which side of the T account does the credit go on? Another very important concept is that your debits must always equal your credits. What I mean by that is if you debit an account for $10, you need to credit an account for $10 so your accounting equation remains balanced. I would recommend watching my video on the accounting equation to emphasize this point. Also, we're going to go into T accounts in greater detail in a future video, but for now, just know that a T account is a way of tracking balances in your accounts. If you look at the picture, you can see that a T account is shaped exactly like the letter T and has the account name across the top, and on the left side is where you record your debits, and on the right side is where you record your credits. Now let's look at the different account types and how debits and credits affect each one. First, I want to define a term you'll hear quite often in your accounting career, and that's normal balance. When you see that term, it's essentially asking you, does a debit or credit make the account balance positive? So in looking at the chart below, a question I might ask a student is, what is the normal balance of the supplies expense account? We can see that the normal balance of an expense account is a debit. So what I mean by that is, if I have a positive balance in my supplies expense account, it must be a debit. Conversely, if I have a negative balance in that account, it must be a credit. We're not going to go through all these account types, but you can just see that, for example, liabilities, a credit increases the liability account, a debit decreases it. So therefore, the normal balance of our liabilities account is a credit balance. In looking at our accounting equation, you'll notice that regardless of the account type, the debits are always on the left and the credits are always on the right. However, the difference is whether a debit increases or decreases an account type. For assets, a debit increases the account balance, but a credit decreases it. For liabilities, a debit decreases the account balance and a credit increases it. For owner's equity, a debit decreases the account balance and a credit increases it. Owner's equity gets a little confusing because there are a few different account types that make it up. Under the owner's equity umbrella, you have revenues, expenses, and owner's draws, and all three make up our owner's equity balance on our balance sheet. What really used to confuse me when I was learning accounting was that if the normal balance of owner's equity is a credit, how come expenses and draws have a debit normal balance while revenue has a credit balance? The reason is because all of these are known as temporary accounts, meaning they get closed out to our owner's equity account at the end of a period. We'll go into detail on the closing process in a later video, but for now I'll just give you a quick example of how to illustrate it. Let's say we have a $10 balance in our expense account and a $20 balance in our revenue account. Since these are temporary accounts, they get closed out at the end of a period so you can start fresh with a zero balance at the beginning of the next period. Period typically meaning a new year. So to get our expense account to zero, we need to credit it for $10. And since debits must always equal credits, we need to debit our income summary account for $10. Remember, debits on the left, credits on the right, so since we're debiting it, we need to put that on the left side of the income summary account. We'll discuss what the income summary account is in a future video, so for now we're just using it so I can illustrate how all these accounts affect our owner's equity account. So we closed out our expense account. Now we need to close out our revenue account. Since we have a credit balance of $20, we need to debit it for $20 to get it to zero. And since debits always must equal credits, since we have a debit for $20, we need to credit our income summary account for $20. Now that we've closed out our revenue and expense accounts, we need to close the circle and close the income summary account to our owner's equity account. Since we have credits for 20 and debits for 10 here, we now have a net credit balance of $10. So to get the income summary account to 0, we need to debit it for $10. So now we have 0 here. And since debits always must equal credit, since we have a debit for 10, we're going to credit our owner's equity account for $10. You can see that even though our expense accounts fall under the owner's equity umbrella and its normal balance is a debit, once we go through the closing process, that debit ends up actually decreasing our owner's equity balance. So how do we remember all of this? Well, the internet is full of memory aids and mnemonics. There are too many to list here, and everyone learns differently. Some might learn through straight memorization, others will use a memory aid, and some will find some other clever way that works for them. One way that helped me learn was the mnemonic dead click, but that requires some different terminology for a couple of account types we've learned so far. Dead refers to the accounts that have normal debit balances, or to put it another way, debiting these accounts increases the balance. Click refers to the accounts that have normal credit balances, or crediting these accounts increases the balance. Here are a few of the modifications you'll have to make in order to make this work. Draws refer to owner's draws. Income is just another name for revenue, so the two are synonymous with each other. And capital is another way owner's equity is sometimes referred to as. Like I said earlier, there are a bunch of different ways to learn these concepts, so find something that works for you. Don't expect to fully understand these things after watching this video just once. It's going to take time and repetition before it starts to make sense. As you progress further in your accounting journey, you'll start to see how all these different concepts start to come together. So don't fret if it doesn't make sense right away. Stick with it and keep practicing. Thank you for watching. Until next time.